Japan just entered into a recession. Japan is among many other countries that officially slip into recessions in 2024. At the same time, the Japanese stock market has been rallying to its all-time high. But why? Shouldn't the stock market be going down if there's a recession? Well, the Japanese stock market and its economy have been an interesting case since the 1980s, where they had a massive asset bubble followed by an enormous market crash with over 2 decades of deflation. So are things finally improving in Japan? And how will this recession impact their stock market moving forward? In this video, I'm going to talk about what has led to its recent stock market rally, and more importantly, how long this rally could last. Don't forget to like and subscribe, and I'll keep delivering interesting content on finance, macroeconomics, and investing. First, let me quickly provide a history of what happened to the Japanese stock market in the 1980s. In the 70s, the Japanese economy was growing rapidly as their export business was booming. Their automobiles, color TVs, steel, and electronic products really gained a competitive edge against other US and European products, and Japan enjoyed a large trade surplus. From around the mid-80s to December of 1989, its market peak, Japan faced a bubble economy caused by a massive speculation and easy credit. This caused all asset prices, including stocks and real estate, to go parabolic and a high inflation at the end of that decade. Japanese central bank started raising interest rates to combat inflation, which then started the crash of the asset market. But not only that, there was an international event called the Plaza Accord, which increased the value of yen dramatically. Japan being an exporter country, strong yen is bad for their economy. It increases the price of Japanese goods to be purchased by foreigners with foreign currency. The strong yen, however, caused Japanese investors and government to invest heavily in foreign assets due to the favorable conversion rate to other currencies. It probably explains why Japan owns so much of the US Treasury bonds, our national debt, compared to many other countries. This trend of foreign investment left their own domestic investment in the gutter for decades. No investment basically meant no growth for domestic companies. This also caused companies not being able to increase wages for their workers, which then caused a feedback loop of declining domestic consumption and deflation in the cost of goods and services. And Japanese consumers consume way less than people in other countries since the 1990s. They were forced to save money, but when everyone is so disciplined to save money like the Japanese, it's not good for the economy. And then there's a long working hour requirement expected by corporate Japan, basically not giving people enough time for leisure and consumption. All this have caused their economy to stagnate for the last 30 years. Fast forward to today, Japan has officially entered into a recession once again, with 2 consecutive quarters of negative GDP growth, which is the definition of the recession used by many economists. Japan is once again facing a weak domestic consumption due to inflation. This inflation, though, unlike the textbook definition of inflation, only increased the price of goods but not wages. When this happens, at first companies will make money from charging more, but eventually the consumers run out of money and they will stop spending. And the Japanese people are very good at not consuming and saving money, unlike people in the US where we're not afraid of using our credit cards. Looking at this chart, Japan's wage growth has been way behind other major countries in the world. So with globally rising prices in fuel, food, and natural resources that they have to import, the Japanese consumers with their stagnating wages just cannot keep up with consumption. But if no one is buying anything in Japan, why is then their stock market rallying to its all-time high? Well, despite their low domestic consumption, there have been some structural tailwinds with the Japanese stock market. First is the yen against the US dollar and other currencies. Yen has been falling, and recently it crashed to its early 1990s level against the USD. And remember, Japan is an exporter country. Their biggest companies by market cap include Toyota, Mitsubishi, Keyence, and Sony, and they all rely heavily on exporting goods to other countries. With yen being really cheap, other countries' purchasing power of Japanese products increase, thereby making it cheaper to buy Japanese goods compared to products made in other countries. And that is the biggest tailwind for the Japanese stock market right now. And trade surpluses are also good for the Japanese government, as the tax receipt will also increase. Another big tailwind is that despite rising inflation, Bank of Japan has been keeping the interest rate really low. Japan has been experimenting with yield curve control, where the government artificially kept the interest rate really low for a long time. Japan has the highest public debt to GDP ratio at 261, so they just cannot raise interest rate or the government will pretty much go bankrupt. To provide you a context, the United States debt to GDP ratio is about 121, so you can see how Japan has a lot of debt. And keeping rates low despite the inflation is not good for the Japanese consumers, but it is good for companies that can benefit from cheap capital and its ability to charge more. And a lot of these large Japanese corporations don't rely solely on domestic consumers for their earnings, because their products are in high demand by the entire world. Not surprisingly, the corporate earnings have been growing recently despite the decrease in domestic consumption. Additionally, Japan is a country that has been historically underinvested since the 90s. A lot of the foreign capitals flowed into China for the last few decades, but as you know, Chinese stock market is facing a serious asset deflation right now, causing a lot of the foreign capital to find a new place. Japan has been a beneficiary of that foreign capital fleeing China. Additionally, the high conversion rate between weak yen and strong USD is keeping Japanese investors to reconsider investing domestically. When you invest in a foreign asset like stocks and bonds of another country, you have to convert money into their currency to do it. So that unfavorable conversion rate from yen to USD is making a lot of domestic investors to reconsider investing domestically, because after making that conversion and buying into the US stock market, which is at its all-time high, it makes it very expensive for Japanese investors. And compared to other countries, the Japanese stock valuation is still pretty cheap, so that's another great incentive for domestic investment. And of course, the USD will inevitably become weaker in the future, and that will be a headwind for Japan. The Federal Reserve is expected to cut rates probably 3 times in 2024, and possibly more if the US enters a recession. Rate cuts in the US will weaken the US dollar. There are also many other headwinds forming right now against the value of the USD, such as uncontrolled government deficit spending and BRICS countries doing away from using US dollars for international transactions. But it seems that the Federal Reserve will keep the rates higher for longer, with the latest CPI report indicating that the inflation is not budging below 3%. So until things break in the US economy and Jerome Powell is forced to cut rates, Japanese stock market still has some more room to run. And of course, if the entire world enters into a recession, thereby the demand for Japanese goods decrease along with everything else, that is another story. And also, if the domestic consumption continues to decline in Japan, that will be bad for most small and medium companies in Japan that don't rely on big exports. And just like in the US, only a handful of few large cap stocks in Japan will continue to lead its stock market rally until bad things happen globally. Well, that's it for today's video. If you like this content, please hit that like button below and subscribe, and thank you for watching.